Welcome back to the deep dive. Today, we are wading into the restaurant sector. It's notoriously choppy waters right now.
Yeah, definitely volatile.
We're focusing on three big names that popped up in our latest screener data showing some, well, pretty wild reactions to signs of consumer weakness.
Right. Our source is that screener data, looking really tight at the last 24 hours of trading. It's been intense.
Mm-hmm.
And we're going to do a proper journalistic breakdown, fundamentals, the technical charts, valuation, what the news is saying.
And we're bringing back our paper money challenge to kind of put some numbers on this volatility.
The fun part.
We're pretending to invest $5,000 right at the previous market close, just to see, hypothetically, how much money you'd have made, or probably more likely right now, lost.
Yeah, it really quantifies the immediate hit, doesn't it?
Exactly. It's about understanding that real-time risk.
And the context here is key. I mean, this whole sector is seeing sharp corrections. Why? Because consumers seem to be pulling back, spending less.
Makes sense.
So before we jump in, just the usual quick reminder, this is all for informational, educational purposes. We're using public data. It is absolutely not investment advice. Please be careful out there.
Got it. Okay, crucial disclaimer noted. Let's get into it. The stock that really grabbed the headlines maybe confirmed everyone's fears. Chipotle. CMG. All right, CMG. It was the biggest stock by trading volume on our list, but wow, it took an absolute beating, down 18.18% in one day.
Just massive. Yeah. For a company that size, that's a huge move.
So what happened? What triggered that kind of sell-off?
Well, it was the Q3 earnings report.
Yeah.
Now, technically, their earnings per share, the EPS, it actually beat what analysts expected.
Oh, okay. So why the plunge then?
Because revenue lagged. And the real kicker was the guidance, looking forward. They cut their forecast for same-store sales growth. Again, for the third consecutive quarter.
Ouch. Third time. That's not a good trend.
No. And the news reports immediately jumped on it, talking about consumer woes, specifically pointing out that lower-income folks, and interestingly, younger consumers, Gen Z, millennials, they seem to be the ones cutting back on that, premium burrito bowl.
That really does sound like a red flag for the whole fast casual space, doesn't it? If Chipotle's seeing it.
Exactly. But here's the complexity. They missed slightly on revenue, cut guidance, yes, but they're still hugely profitable. We're talking, what, $1.54 billion in income? Return on equity near 45%. Those are strong numbers.
So why the 18% haircut? Seems disproportionate if the underlying business is still making good money.
It really boils down to expectations, growth expectations. CMG has been priced, almost for perfection.
Right.
You look at that trailing PE ratio, price to earnings, it's up there at 28.67. But maybe more telling is the PEG ratio that compares the PE to the expected growth rate. It's high at 3.02.
Okay, so a PEG over 1 suggests the price might be ahead of the growth. Over 3 is pretty steep.
It is. And if a company carries that kind of multiple, it has to deliver on those high growth promises. Missing or lowering guidance, especially 3 times in a row.
Yeah.
Well, that triggers this kind of massive de-risking. Investors just flee.
Okay, that connects the dots. The market's basically saying, whoa, the growth story we paid for isn't quite panning out. Time to reprice.
Precisely. Though it's interesting, analysts, long-term, still seem fairly positive. Their average recommendation is leaning towards a strong buy.
So Wall Street thinks this consumer pullback is maybe temporary, a blip.
Seems like they view it as more cyclical, yeah. But right now, looking at the chart, the technical picture, it is brutal. CMG is in a sharp downtrend. But here's where it gets potentially interesting, maybe for traders. The RSI, the Relative Strength Index, it's way down at 19.29.
19, wow. And typically below 30 is considered oversold, right?
Exactly. So technically speaking, the stock is screaming oversold. It might be due for some kind of bounce purely on technicals.
But betting on a technical bounce when the fundamental reason for the drop, actual customers cutting back, is so clear, that feels pretty risky.
Oh, absolutely. It's a pure volatility play at this point. The selling was so fast and hard, it might have overshot. Technically, it's primed for a possible short-term pop. But yeah, weekly volatility is high, 3.77%. It's not for the faint of heart.
Okay, let's quantify that risk. Our paper money challenge. We simulate buying $5,000 worth at yesterday's close, which was $39.76. How bad was the damage by the end of the day?
Right, so that $5,000 would get you approximately 125 shares. Total investment, about $4,970.
And after that 18% drop, closing at $32.53.
Your investment is now worth $4,066.25. That's a paper loss of $903.75. Pretty much confirms that brutal 18.18% plunge. Yeah, ouch is right.
Okay, that was a rough start with CMG. Let's shift gears completely. Let's look at Starbucks SBUX, sort of the steady giant in this space.
Yeah, the behemoth. Highest market cap on our list, $94.5 billion.
And the contrast is stark. While Chipotle cratered is 18%, Starbucks had just a modest drop, down only 1.21% on the day.
It's a fascinating divergence, isn't it? Starbucks also had earnings. Theirs were a bit mixed, too. EPS actually missed estimates slightly.
Oh, they missed.
Yeah, but crucially, revenue beat expectations. And the big headline for them, the narrative, was that they managed their first global sales increase in almost 2 years.
Wow. Okay, so right when Chipotle is warning about consumers pulling back, Starbucks sees sales increase globally.
It seems that way. It's quite the contrast.
So is the takeaway that people might cut back on a $15 lunch bowl, but they're not giving up their $5 daily coffee ritual? Is that the idea?
That definitely seems to be the story the CEO is pushing. They're talking up their turnaround plan, claiming it's ahead of schedule.
What's in that plan?
Well, part of it seems to be adapting. They're planning 1,000 store renovations, and they're testing a new budget prototype store.
Yeah.
So they're actively trying to meet consumers where they are, focusing on that reliable, maybe affordable premium experience.
Interesting. Looking at their financials, though, I did notice the quick ratio and current ratio, those liquidity measures, they look kind of tight, 0.51 and 0.72. Is that a concern? Especially compared to CMG or CVA, which seem to have more cash on hand.
It's context, right? That's fairly typical for a very mature, established brand like Starbucks. They often carry more debt, focus on operations, and returning capital to shareholders.
Like the dividend.
Exactly. They offer a pretty solid 3.03% dividend yield. Now, the payout ratio is high, meaning they pay out a lot of their earnings as dividends, but it's consistent.
And valuation still looks high, PE over 50.
The trailing PE is high, yeah, 51.03. But look at the forward PE. It drops quite a bit, down to 27.35. That tells you analysts are buying into that turnaround story and expect earnings to grow significantly.
Okay. And technically, the stock chart reflects the stability you're talking about.
Absolutely. It's like the picture of relative calm compared to CMG. The beta is almost exactly 1.01, meaning it moves pretty much in line with the overall market, not extra volatile.
Where's the price relative to moving averages?
It's just hovering right around its short-term averages, like the 20-day and the RSI, smack in the middle, 45.67, neutral territory, no extreme signals here.
It really reflects that market confidence, doesn't it? Steady as she goes.
Pretty much.
All right, let's check that stability with the paper money challenge. Buying $5,000 at the previous close of $84.17, that gets us about 59 shares.
Yep, 59 shares for around $4,966 invested.
And closing at $83.15. What's the paper loss?
Minimal, really. The final value is $4,905.85. So a paper loss of only $60.18.
Wow.
That's just that tiny 1.21% daily whoop, a much, much calmer experience than holding CMG through that day.
Okay, night and day between those two. Now let's hit our third stock, CAVA Group, CAVA. This one feels like the high growth, maybe high risk cousin in the group.
That's a good way to put it. It's the smallest by market cap here, $6.2 billion, and it also got hammered, down 11.20% on the day.
So almost as bad as Chipotle. Why? Did they have bad news too?
Nope. No specific news from CAVA itself. This looks like pure sector contagion,
Maybe.
meaning Chipotle's bad news just dragged everyone else down with it. News reports explicitly said CAVA was struggling after Chipotle's dismal results.
So the market just assumed if Chipotle's customers are pulling back, CAVA's must be too.
Pretty much. Fear spreads fast, especially in a volatile sector. And CAVA being seen as a younger, high-growth story in that same premium fast casual space, it got hit hard. Investors got spooked.
Even though CAVA's growth numbers on paper look really strong. Sales growth over 20% quarter over quarter. Big earnings forecast.
Undeniably strong growth metrics. But that brings us back to valuation. Like CMG, but maybe even more so, CAVA is priced for massive future growth.
How high are we talking?
The forward PE ratio is nearly 80, 79.96. The price to sales is also high at 5.7 to 5. This is a valuation built almost entirely on hope and future expectations.
Okay, so when the biggest player in your niche stumbles.
The market aggressively sells off the high flyers first, asking questions later, especially with CAVA's own earnings report coming up soon, November 4th. People are de-risking before that, fearing they might echo Chipotle's warnings.
Adds another layer of risk, and you mentioned CAVA as high risk. The beta reflects that.
Oh yeah. Volatility is the name of the game here.
Yeah.
CAVA's beta is 2.50. That's the highest of the three by far.
What does a 2.5 beta mean in simple terms for listeners?
It means CAVA is way more volatile than the overall market, like 2.5 times more volatile. So small market moves can mean huge swings for CAVA, up or down.
So when the sector catches a cold because of Chipotle?
CAVA gets pneumonia, which is basically what we saw.
Yeah.
And another point from the data, maybe adding to the jitters, insider activity.
What about
Insider ownership is pretty high, which can be good. But recent transactions show a negative trend. Multiple company officers have been reporting sales of their stock plan through 2025.
Insiders selling when the stock's already plunging. Not exactly a confidence booster.
Not ideal timing, though.
Okay, technically, where does this leave CAVA after that 11% drop?
It's trading really close to its 52-week low. Deeply in a downtrend overall, it's down something like 61% over the past year.
Oof.
And just like Chipotle, that sharp sellout has pushed its RSI into oversold territory. It's at 27.1 times.
So another technically oversold situation, but maybe even riskier given the beta and the valuation.
Exactly. It perfectly illustrates what happens to these high multiple growth darlings when the market mood sours. The fall can be incredibly fast and painful.
All right, let's run the final paper money numbers. $5,000 invested in CAVA at the previous close of $60.47. How many shares is that?
That would get you about 82 shares for a total investment near $4,958.
And after dropping 11.2% to close at $53.70.
That investment is now worth $4,403.14. So the paper loss is $555.14.
Still big hit. Confirms that 11.20% drop. High beta cuts both ways, especially when the market's heading down.
Absolutely. Volatility magnifies losses just as much as gains. #tag outro.
Okay, so wrapping this up, this deep dive really paints a clear picture, doesn't it? 3 companies in the same sector, same economic headwinds, but very different reactions.
Yeah, a really clean comparison.
You had Chipotle leading the charge downwards, losing that huge 18%, really confirming those fundamental worries about consumer demand, especially among younger people, cutting back on fast casual.
Right. Then CAVA gets dragged down with it, losing over 11%, mostly due to that sector fear and its own sky-high valuation being questioned. High beta doing its thing.
But then the key divergence.
SBUX, showing relative stability, barely moving, and crucially, reporting improved global sales. It really highlights a potential split in consumer behavior.
How so?
Well, it suggests that while people might be cutting back on the more expensive, maybe discretionary fast casual meal like Chipotle or CAVA, they're still prioritizing that smaller, perhaps more ritualistic, premium coffee purchase from Starbucks. Value perception might be shifting.
And remember, the news around Chipotle's problems specifically mentioned Gen Z and millennials feeling the pinch. Student loans, maybe job market worries.
Exactly. And that raises a really important final thought for you, the listener, to maybe chew on.
Okay.
If this pullback in premium fast casual dining isn't just a blip, if it reflects a more fundamental, maybe longer-lasting shift in how much disposable income these huge younger demographic groups have, how long does that dynamic stick around?
Good question.
And looking further out, when economic confidence eventually does return, which part of the restaurant market is actually best positioned to capture that next wave of spending? Is it the deep value chains? Is it the reliable premium quick serve like Starbucks? Or do the high-growth, fast-casual players like CMG and CAVA bounce back strongest?
That's definitely something to think about. Where does the consumer dollar go next? Fascinating stuff.
Indeed.
All right, that's all the time we have for this deep dive. Thanks for tuning in. We'll catch you next time.